Welcome to video exploring the fascinating world of cryptocurrency. In this digital age, the term cryptocurrency has become a buzzword, but do you really know what it means and how it works? Today, we'll take you on a journey to demystify this revolutionary form of money and understand the technology that underpins it. Let's start by defining cryptocurrency. At its core, cryptocurrency is a decentralized and digital form of currency that relies on cryptography for secure transactions. Unlike traditional fiat currencies issued by governments and central banks, cryptocurrencies are not controlled by any single entity. Instead, they operate on a technology called the blockchain. One of the most significant impacts of cryptocurrencies is the potential for increased financial inclusion. In many parts of the world, millions of people lack access to traditional banking services, either due to insufficient infrastructure or onerous regulations. Cryptocurrencies provide an alternative means of transacting and storing value, enabling individuals without access to banks to participate in the global economy. For example, in countries with high inflation rates, people often struggle to preserve their wealth in local fiat currencies. Cryptocurrencies like Bitcoin offer a hedge against inflation and provide a way to store value in a more stable asset. Additionally, cryptocurrencies can facilitate cross-border transactions without the need for costly intermediaries, making remittances more efficient and affordable for migrant workers. Cryptocurrencies have the potential to disrupt traditional financial intermediaries like banks, payment processors, and remittance services. By eliminating these intermediaries, transaction fees can be significantly reduced, and processing times can be accelerated. This disintermediation also empowers individuals to have more control over their financial assets and eliminates the risk of financial censorship or freezing of funds by third-party entities. Furthermore, cryptocurrencies enable peer-to-peer lending and borrowing, cutting out the need for banks as intermediaries in these processes. This direct lending mechanism can provide individuals and small businesses with easier access to capital, fostering economic growth and innovation. Cryptocurrencies offer enhanced security and privacy compared to traditional financial systems. The cryptographic nature of transactions ensures that only the intended recipients can access funds, reducing the risk of fraud and unauthorized access. Additionally, the pseudonymous nature of cryptocurrency addresses provides a level of privacy that is not always present in traditional financial transactions. While privacy features in cryptocurrencies have raised concerns about potential misuse for illicit activities, there is a growing recognition that privacy is an essential aspect of financial freedom and protection against identity theft. The rise of cryptocurrencies has opened up new investment opportunities for individuals seeking alternative assets beyond traditional stocks, bonds, and real estate. Many investors view cryptocurrencies as a potential store of value and a hedge against economic uncertainties. As a result, the cryptocurrency market has experienced significant growth, attracting both retail and institutional investors. However, the speculative nature of the cryptocurrency market has also led to extreme price volatility, making it a high-risk investment option. Investors should exercise caution and conduct thorough research before investing in cryptocurrencies. Despite the potential benefits of cryptocurrencies, several challenges and regulatory concerns have emerged. The cryptocurrency market's extreme volatility is a double-edged sword. While it can provide opportunities for significant profits, it also exposes investors to substantial risks. Price fluctuations in cryptocurrencies can be influenced by various factors, including market sentiment, technological advancements, regulatory developments, and macroeconomic events. While cryptocurrencies are built on robust cryptographic principles, they are not immune to security breaches. Hackers have targeted cryptocurrency exchanges and wallets, resulting in the loss of millions of dollars worth of digital assets. The responsibility of securing private keys lies with the users, and any lapse in security can lead to irreversible losses. The regulatory environment surrounding cryptocurrencies varies significantly across different countries and jurisdictions. Some governments have embraced cryptocurrencies and blockchain technology, fostering innovation and creating a conducive environment for growth. On the other hand, some countries have taken a more cautious approach, with concerns over money laundering, tax evasion, and consumer protection. The lack of uniform regulations and clarity in some regions has led to uncertainties for businesses and investors in the cryptocurrency space. Additionally, regulatory changes in one jurisdiction can have ripple effects on the global cryptocurrency market. The energy consumption associated with cryptocurrency mining has been a subject of criticism. Proof of work, POW, consensus mechanisms, which are used by some cryptocurrencies like Bitcoin, require vast amounts of computational power. This has raised concerns about the environmental impact of cryptocurrency mining, as it can lead to increased carbon emissions. To address these concerns, some cryptocurrencies are exploring alternative consensus mechanisms, such as proof of stake, POS, which require significantly less energy and have a lower environmental footprint. As cryptocurrencies gain popularity, scalability becomes a critical challenge. Bitcoin's original design allows for a limited number of transactions per second, which can lead to congestion and higher transaction fees during periods of high demand. To address this, various projects are working on solutions like second-layer protocols and off-chain scaling solutions. To understand how cryptocurrency works, let's dive into the blockchain. Think of the blockchain as a public ledger that records all transactions across a vast network of computers called nodes. Each transaction is bundled into a block, and multiple blocks are linked together in chronological order, forming a chain, hence the name blockchain. Now, here's the exciting part: new blocks are added to the blockchain through a process known as mining. Miners are individuals or groups of people who use powerful computers to solve complex mathematical problems. When a miner successfully solves a problem, they validate and record a new block of transactions onto the blockchain. As a reward for their efforts, they receive a certain amount of the cryptocurrency they are mining. One of the key features of cryptocurrency is its security. Transactions on the blockchain are secured by cryptographic algorithms, making it extremely difficult for anyone to alter or tamper with the data. This level of security ensures that transactions are trustworthy and transparent, making cryptocurrency an attractive option for digital payments. Additionally, cryptocurrencies often offer a degree of anonymity. While transactions are recorded on the public blockchain, the identity of the individuals involved remains encrypted. This anonymity can be both a benefit and a challenge, as it has led to some concerns about its use for illegal activities. There are thousands of cryptocurrencies in existence, but some of the most well-known ones include Bitcoin, Ethereum, and Litecoin. Bitcoin, introduced in 2009, is considered the first and most valuable cryptocurrency. Ethereum, on the other hand, was designed to support smart contracts and decentralized applications, adding a new layer of functionality to blockchain technology. The world of cryptocurrency extends beyond digital money. Its underlying technology, the blockchain, has numerous potential applications across various industries. For instance, blockchain can be used to revolutionize supply chain management, enhance voting systems, streamline healthcare records, and create more transparent charitable donations. While the world of cryptocurrency offers exciting possibilities, it also comes with risks and challenges. The volatile nature of cryptocurrency prices can lead to significant investment risks. Additionally, security breaches and hacking attempts have affected various cryptocurrency exchanges and wallets, highlighting the importance of robust security measures and individual responsibility. Cryptocurrency has emerged as a disruptive force in the world of finance, revolutionizing the way we perceive and utilize money. At its core, cryptocurrency is a decentralized and digital form of currency that relies on cryptography for secure transactions. Unlike traditional fiat currencies issued by governments and central banks, cryptocurrencies are not controlled by any single entity. Instead, they operate on a technology called the blockchain. In this comprehensive essay, we will delve into the origins of cryptocurrency, its underlying technology, its impact on the financial landscape, and its potential future. The origins of cryptocurrency can be traced back to the late 2000s when an enigmatic figure named Satoshi Nakamoto introduced Bitcoin, the first and most well-known cryptocurrency, in a white paper titled Bitcoin, a peer-to-peer electronic cash system in 2008. The following year, the Bitcoin network was launched, and it marked the beginning of a new era in finance. Satoshi Nakamoto's true identity remains unknown, adding an air of mystery to the birth of cryptocurrency. The underlying technology that powers cryptocurrencies is the blockchain. A blockchain is a decentralized and distributed ledger that records all transactions made with a particular cryptocurrency. The ledger is maintained by a network of nodes, computers, that validate and add new transactions to the chain. Each block contains a cryptographic link to the previous block, creating an immutable and transparent record of all transactions. This technology ensures that transactions are secure, transparent, and tamper-resistant, eliminating the need for intermediaries like banks. The impact of cryptocurrencies on the financial landscape has been profound. One of the primary advantages of cryptocurrency is its potential to provide financial inclusion to the unbanked and underbanked populations around the world. With a smartphone and internet access, anyone can access cryptocurrencies, enabling financial services and transactions without the need for a traditional bank account. This has the potential to empower millions of people who have been excluded from the formal financial system. Cryptocurrencies have also gained popularity as an alternative investment class. Bitcoin, in particular, has attracted significant attention from investors seeking a store of value or a hedge against inflation. Its limited supply of 21 million coins and the absence of central authority make it an attractive asset for those wary of traditional monetary policies. Furthermore, cryptocurrencies have facilitated the growth of innovative financial products and services. Decentralized finance, DeFi, platforms have emerged, allowing users to lend, borrow, and earn interest without intermediaries. Non-fungible tokens, NFTs, have enabled the creation and ownership of unique digital assets, revolutionizing the art and gaming industries. However, the rise of cryptocurrencies has not been without challenges. The decentralized and pseudonymous nature of cryptocurrencies has led to concerns about their use in illegal activities such as money laundering and tax evasion. Regulatory bodies around the world are grappling with how to address these challenges while striking a balance that fosters innovation while protecting consumers and the financial system. Despite the challenges, the potential future of cryptocurrencies remains promising. As the technology matures, scalability and energy efficiency improvements will likely be made, addressing current limitations. Moreover, governments and central banks are exploring the possibility of issuing their own digital currencies, known as central bank digital currencies, CBDCs, which could further integrate cryptocurrencies into the mainstream financial system. The concept of cryptocurrencies can be traced back to the late 20th century, with various attempts to create digital currencies that were free from centralized control. However, it wasn't until the early 2000s that significant progress was made in this field. The concept of cryptocurrencies can indeed be traced back to the late 20th century, and the idea of creating digital currencies that operate independently from centralized control has intrigued researchers and computer scientists for decades. One of the earliest attempts at creating digital currency was in the 1980s when American computer scientist named David Chaum introduced eCash. The concept of eCash involved the use of cryptographic techniques to enable secure and anonymous transactions. Although eCash did not gain widespread adoption, it laid the groundwork for future developments in the field of digital currencies. In the late 1990s, another significant development emerged with the introduction of B-Money by Wei Dai, a computer engineer and cypherpunk. B-Money proposed the idea of a decentralized electronic currency that relied on cryptographic proof of work for verification. Although B-Money was never implemented, it contributed to the theoretical framework of decentralized digital currencies. Shortly after B-Money, in 1998, computer scientist and cryptographer Wei Dai introduced BitGold. BitGold was another precursor to cryptocurrencies and proposed a system where participants would solve computational puzzles to create new units of the currency and validate transactions. While BitGold never gained practical implementation, its ideas served as a stepping stone for future cryptocurrency endeavors. However, it wasn't until the early 2000s that significant progress was made towards the actual implementation of cryptocurrencies. In 2004, Hal Finney, a developer and cryptographer, introduced reusable proof of work, RPOW, a system that allowed users to purchase tokens using computational work. While RPOW was not a fully decentralized currency, it demonstrated the potential of cryptographic proof of work as a method for securing digital transactions. Then, in 2008, the pivotal moment in the history of cryptocurrencies occurred with the release of the Bitcoin white paper by an individual or group using the pseudonym Satoshi Nakamoto. Bitcoin represented a groundbreaking concept that combined previous ideas like cryptographic proof of work, decentralized control, and a secure, transparent ledger known as the blockchain. The Bitcoin network officially went live in January 2009, marking the birth of the first practical and widely adopted cryptocurrency. Bitcoin's success inspired the creation of numerous alternative cryptocurrencies, often referred to as altcoins, which sought to address various issues or provide additional features beyond what Bitcoin offered. Some notable examples include Litecoin, introduced in 2011 by Charlie Lee, which aimed to improve transaction speed and efficiency, and Ripple, now known as XRP, which aimed to facilitate fast and low-cost cross-border payments. Since the emergence of Bitcoin, the cryptocurrency space has experienced exponential growth, with thousands of different cryptocurrencies in existence by the time of my knowledge cutoff in September 2021. Alongside this growth, the underlying blockchain technology has found applications beyond digital currencies, including supply chain management, smart contracts, and decentralized applications, dApps. One of the first notable efforts was B-Money, proposed by Wei Dai in 1998. B-Money was envisioned as an anonymous, distributed electronic cash system that used cryptographic proof of work to validate transactions. This concept laid the groundwork for the development of later cryptocurrencies. In 2004, Hal Finney introduced reusable proof of work, RPOW, a system that allowed users to purchase tokens that could be redeemed for proof of work solutions. Although RPOW was an essential precursor to cryptocurrencies, it did not achieve widespread adoption. The real breakthrough came in 2008 when an individual or group using the pseudonym Satoshi Nakamoto released a white paper titled Bitcoin, a peer-to-peer electronic cash system. This white paper outlined the design and underlying principles of Bitcoin, the first ever cryptocurrency. In January 2009, Nakamoto mined the first block of the Bitcoin blockchain, known as the Genesis block. This marked the birth of Bitcoin and the beginning of a new era in finance. At the heart of every cryptocurrency is blockchain technology. The blockchain is a distributed ledger that records all transactions made within the network. Unlike traditional databases, which are centrally controlled, the blockchain is maintained by a decentralized network of computers, nodes, spread across the globe. When a new transaction is initiated, it is bundled with other pending transactions into a block. Miners or validators in the network compete to solve complex mathematical puzzles to add the block to the blockchain. Once the puzzle is solved, the new block is appended to the existing chain, and the transaction becomes a permanent part of the public ledger. This process is known as mining or consensus mechanism, and it ensures the security and immutability of the blockchain. The decentralized nature of blockchain technology makes it highly resistant to censorship and fraud. Since multiple nodes hold a copy of the ledger, altering a single transaction would require changing the data on all nodes simultaneously, which is practically impossible due to the massive computational power required. Cryptocurrency price volatility and market trends. Analyzing factors influencing volatile nature of cryptocurrency prices and insights into future developments. Cryptocurrencies, since their inception, have been known for their extreme price volatility, with wild fluctuations occurring over short periods. This phenomenon has been both a point of fascination and concern for investors, traders, and the wider financial community. Understanding the factors that influence cryptocurrency price volatility and studying historical market trends can provide valuable insights into potential future developments. Market sentiment and news impact. Cryptocurrency markets are heavily influenced by investor sentiment and news events. Positive news, such as institutional adoption or regulatory developments, often leads to price rallies, while negative news, like security breaches or regulatory crackdowns, can cause sharp declines. The relatively nascent and speculative nature of the market makes it highly responsive to market sentiment and information flow. Lack of fundamental value. Unlike traditional assets like stocks or bonds, cryptocurrencies lack inherent value or cash flow. Their prices are largely driven by supply and demand dynamics and speculative trading, making them more susceptible to sudden price swings. The absence of underlying assets or cash flow streams can amplify volatility, as price discovery relies heavily on market sentiment. Market liquidity and trading volumes. Cryptocurrency markets tend to have lower liquidity compared to traditional financial markets, which can exacerbate price fluctuations. Limited liquidity means that large buy or sell orders can have a significant impact on prices, leading to sudden spikes or crashes. Additionally, trading volumes can vary widely, with low volume periods leading to increased price volatility. Regulatory environment. Cryptocurrency markets are influenced by the regulatory environment in different jurisdictions. Ambiguous or restrictive regulations can create uncertainty and dampen investor confidence, leading to price declines. On the other hand, favorable regulations and increased institutional adoption can fuel bullish trends. Technological developments and upgrades. Technological advancements and upgrades to blockchain networks can impact cryptocurrency prices. Positive developments, such as network improvements or the launch of new features, can attract investor interest and drive prices higher. Conversely, security vulnerabilities or contentious hard forks can cause price volatility. Market manipulation and whales. Cryptocurrency markets have been known to experience manipulation, particularly in the form of pump and dump schemes. Large holders, often referred to as whales, can influence prices by executing significant trades, leading to price swings that can impact market sentiment. Correlation with traditional markets. Despite being a relatively new asset class, cryptocurrencies have shown some correlation with traditional financial markets during times of economic uncertainty. Events in global financial markets and macroeconomic trends can influence investor behavior in cryptocurrency markets, leading to increased volatility. To gain insights into potential future developments, it is crucial to study historical market trends. Cryptocurrency history is filled with cycles of boom and bust, characterized by periods of exponential price growth followed by sharp corrections. These patterns can provide valuable information on potential price movements. As the cryptocurrency market matures and gains more mainstream acceptance, it may experience reduced volatility. Increased adoption, regulatory clarity, and improvements in market infrastructure can contribute to a more stable market environment. Additionally, the integration of cryptocurrencies into traditional financial systems, such as the development of Bitcoin exchange-traded funds, ETFs, could potentially lead to more stable price trends. In conclusion, cryptocurrency price volatility is driven by a combination of factors, including market sentiment, news impact, liquidity, regulations, technological developments, market manipulation, and correlations with traditional markets. Understanding these drivers and analyzing historical market trends can provide valuable insights for investors and traders, helping them navigate the dynamic landscape of cryptocurrencies. As the market evolves, it is likely that increased adoption and regulatory developments will play a significant role in shaping the future volatility and stability of cryptocurrency prices. Scalability is one of the most critical challenges faced by popular cryptocurrencies like Bitcoin and Ethereum. As these networks gain widespread adoption, their limited transaction processing capacity becomes increasingly evident. To accommodate a growing user base and ensure efficient and cost-effective transactions, various scalability solutions have been proposed and implemented. Among these solutions, Layer 2 protocols and sharding have emerged as promising approaches to address scalability issues. Scalability challenges: Bitcoin and Ethereum are both based on a blockchain architecture, where each transaction must be verified and recorded on the public ledger by multiple nodes in the network. As the number of users and transactions increases, the capacity of these networks to process transactions becomes limited. Bitcoin's block time of approximately 10 minutes and Ethereum's block time of about 15 seconds lead to relatively low transaction throughput. Layer 2 protocols aim to improve scalability by moving some of the transaction processing off the main blockchain, reducing the burden on the primary network. These protocols build on top of the underlying blockchain and enable faster and cheaper transactions. One of the most notable Layer 2 solutions is the Lightning Network for Bitcoin and the similar Raiden Network for Ethereum. These networks create off-chain payment channels between users, allowing them to conduct numerous transactions without clogging the main blockchain. Once the channel is closed, the final transaction is recorded on the blockchain, ensuring security and decentralization. Sharding is a scaling technique that aims to increase transaction throughput by dividing the blockchain into smaller, more manageable parts called shards. Each shard processes a subset of transactions, enabling parallel processing and significantly increasing the network's overall capacity. Ethereum has been actively working on implementing sharding through its Ethereum 2.0 upgrade. With sharding, the Ethereum network is expected to achieve thousands of transactions per second, making it more suitable for mass adoption and dApps, decentralized applications, with high transaction demands. Plasma and sidechains are other Layer 2 scaling solutions that enhance the capabilities of the main blockchain. Plasma is a framework that allows for the creation of child chains or plasma chains connected to the main blockchain, enabling faster and cheaper transactions. Sidechains, on the other hand, are separate blockchains that are interoperable with the main chain, providing more flexible and scalable options for specific use cases. Optimistic rollups and ZK rollups are Layer 2 scaling solutions that use cryptographic techniques to bundle multiple transactions into a single batch, reducing the computational burden on the main blockchain. These solutions achieve scalability without compromising security and decentralization, making them attractive options for Ethereum and other smart contract platforms. While Layer 2 protocols and sharding show great promise in addressing scalability issues, implementing and adopting these solutions requires careful consideration of security, decentralization, and interoperability. Developers and researchers continue to explore various approaches to ensure that scalability improvements do not compromise the fundamental principles of blockchain technology. Challenges: limited infrastructure. Developing countries often have limited access to the internet and digital infrastructure, hindering the widespread adoption of cryptocurrencies. To utilize cryptocurrencies effectively, individuals need access to smartphones or computers and reliable internet connectivity. Financial literacy. Cryptocurrencies can be complex for individuals with limited financial literacy. Understanding how to use and manage digital wallets, private keys, and transactions can be a barrier to entry. Volatility. Cryptocurrencies are known for their price volatility, which can be a concern for people with limited financial resources. Rapid price fluctuations may deter potential users from adopting cryptocurrencies as a store of value or medium of exchange. Regulatory uncertainty. Many developing countries lack clear and comprehensive regulations concerning cryptocurrencies. The absence of clear guidelines can create uncertainty for businesses and individuals, affecting their willingness to participate in the cryptocurrency ecosystem. Security and fraud concerns. Cryptocurrency transactions, once confirmed, are irreversible. This aspect raises concerns about potential scams, fraud, and hacking risks, especially for users who may not have access to robust cybersecurity measures. Benefits: financial inclusion. Cryptocurrencies can provide financial services to unbanked and underbanked populations in developing countries. With a smartphone and internet access, individuals can access financial services without relying on traditional banks, which may be scarce in some regions. Remittances. Cryptocurrencies offer a more efficient and cost-effective way to send and receive remittances across borders. By eliminating intermediaries and reducing transaction fees, cryptocurrencies can increase the amount of money received by recipients. Access to global markets. Cryptocurrencies enable individuals in developing countries to access global markets and participate in cross-border trade and investments without the need for traditional financial intermediaries. Economic growth and entrepreneurship. Cryptocurrencies can foster innovation and entrepreneurship in developing nations by providing a new financial ecosystem that facilitates crowdfunding, tokenization of assets, and access to global capital. Protection against inflation. In countries with high inflation rates, cryptocurrencies can serve as a store of value, providing an alternative to volatile local currencies and protecting wealth from loss of purchasing power. Financial sovereignty. Cryptocurrencies empower individuals to have direct control over their finances without relying on centralized authorities. This aspect can be particularly beneficial in regions with unstable or corrupt financial systems. To unlock the full potential of cryptocurrencies in developing nations, efforts are needed to improve digital infrastructure, promote financial education, establish clear and supportive regulations, and develop user-friendly and secure cryptocurrency platforms. By addressing these challenges and leveraging the benefits, cryptocurrencies can play a transformative role in advancing financial inclusion and economic growth in developing countries. Cryptocurrencies have grown exponentially in popularity and market value over the past decade, prompting governments worldwide to address the regulatory challenges posed by this disruptive technology. The global regulatory landscape for cryptocurrencies is complex and diverse, with each country adopting a unique approach to address issues related to consumer protection, financial stability, money laundering, tax evasion, and investor security. In this article, we will explore the state of cryptocurrency regulations, the challenges faced by governments in regulating them, and the potential impact of regulations on the crypto market. 1. Global regulatory landscape. The regulatory environment for cryptocurrencies varies significantly from country to country. Some nations have embraced cryptocurrencies and blockchain technology, fostering innovation and investment, while others have taken a cautious or even hostile stance, citing concerns over potential risks. Here are some common regulatory approaches observed worldwide. Pro-crypto and progressive regulations. Countries like Switzerland, Singapore, and Malta have taken a pro-crypto stance, implementing clear and progressive regulations that encourage blockchain innovation and attract cryptocurrency businesses. These jurisdictions often offer favorable tax frameworks, regulatory sandboxes, and supportive legal structures to nurture the growth of the crypto industry. Moderate and balanced regulations. Countries like the United States, Japan, and Australia have adopted a more moderate approach, implementing regulations to address risks while allowing for crypto market growth. They often apply existing financial regulations to cryptocurrencies, considering them as assets or commodities, and subject them to anti-money laundering, AML, and Know Your Customer, KYC, requirements. Restrictive and cautious regulations. On the other hand, countries like China and India have imposed strict regulations, including outright bans on cryptocurrency trading and initial coin offerings, ICOs. These measures are driven by concerns over speculative bubbles, fraud, and potential risks to financial stability. 2. Challenges faced by governments. Regulating cryptocurrencies presents several challenges for governments and regulatory bodies, largely due to the unique characteristics of this emerging asset class. Pace of technological innovation. Cryptocurrencies and blockchain technology evolve rapidly, outpacing traditional regulatory frameworks. Governments often struggle to keep up with the pace of technological advancements, leading to uncertainty and delayed regulations. Global nature of cryptocurrencies. Cryptocurrencies operate on a borderless and decentralized network, making it challenging for individual countries to regulate them effectively. A regulatory action taken by one country may have unintended consequences beyond its borders. Anonymity and privacy concerns. Cryptocurrencies offer a degree of anonymity, which can be misused for illicit activities, such as money laundering and terrorist financing. Balancing the need for privacy with the imperative to combat financial crimes is a delicate challenge. Classification of cryptocurrencies. Governments often grapple with the question of how to classify cryptocurrencies. Are they currencies, assets, securities, or commodities? The classification can have significant implications for taxation, legal status, and regulatory oversight. Lack of international coordination. The absence of international coordination in cryptocurrency regulations can lead to regulatory arbitrage, where businesses move to countries with more favorable regulatory environments, potentially creating regulatory loopholes. 3. Potential impact of regulations on the crypto market. The regulatory landscape significantly influences the cryptocurrency market, affecting investor sentiment, market liquidity, innovation, and institutional adoption. Here are some potential impacts of regulations on the crypto market. Market volatility. Announcements or changes in regulations can trigger significant price volatility in the cryptocurrency market. Uncertainty surrounding regulations may lead to increased market fluctuations and reduced investor confidence. Market entry and exit. Strict or ambiguous regulations may deter new players from entering the crypto market, limiting competition and innovation. Conversely, clear and supportive regulations can attract new investments and foster market growth. Institutional adoption. Institutional investors often require regulatory clarity and legal protections before entering the cryptocurrency market. Robust regulations can provide the confidence needed for institutional adoption, potentially leading to increased market liquidity and stability. Investor protection. Regulations that prioritize investor protection can help safeguard against fraudulent schemes and scams, improving investor confidence and encouraging long-term participation in the market. Innovation and development. Favorable regulations can stimulate blockchain and cryptocurrency innovation, leading to the development of new use cases, decentralized applications, dApps, and smart contract platforms. Cross-border transactions. International regulations can impact cross-border cryptocurrency transactions and remittances. Harmonized regulations across countries may facilitate smoother global cryptocurrency transactions. Balancing the need for investor protection and financial stability with the promotion of innovation and growth in the cryptocurrency space remains a complex task for policymakers. As the crypto market continues to mature, it is likely that regulatory frameworks will evolve and adapt to accommodate the dynamic nature of this disruptive technology. Striking the right balance between regulation and innovation is crucial to unlocking the full potential of cryptocurrencies while mitigating potential risks. Cryptocurrency has emerged as a disruptive force in the world of finance, revolutionizing the way we perceive and utilize money. At its core, cryptocurrency is a decentralized and digital form of currency that relies on cryptography for secure transactions. Unlike traditional fiat currencies issued by governments and central banks, cryptocurrencies are not controlled by any single entity. Instead, they operate on a technology called the blockchain. In this comprehensive essay, we will delve into the origins of cryptocurrency, its underlying technology, its impact on the financial landscape, and its potential future. The origins of cryptocurrency can be traced back to the late 2000s when an enigmatic figure named Satoshi Nakamoto introduced Bitcoin, the first and most well-known cryptocurrency, in a white paper titled Bitcoin, a peer-to-peer electronic cash system in 2008. The following year, the Bitcoin network was launched, and it marked the beginning of a new era in finance. Satoshi Nakamoto's true identity remains unknown, adding an air of mystery to the birth of cryptocurrency. The underlying technology that powers cryptocurrencies is the blockchain. A blockchain is a decentralized and distributed ledger that records all transactions made with a particular cryptocurrency. The ledger is maintained by a network of nodes, computers, that validate and add new transactions to the chain. Each block contains a cryptographic link to the previous block, creating an immutable and transparent record of all transactions. This technology ensures that transactions are secure, transparent, and tamper-resistant, eliminating the need for intermediaries like banks. The impact of cryptocurrencies on the financial landscape has been profound. One of the primary advantages of cryptocurrency is its potential to provide financial inclusion to the unbanked and underbanked populations around the world. With a smartphone and internet access, anyone can access cryptocurrencies, enabling financial services and transactions without the need for a traditional bank account. This has the potential to empower millions of people who have been excluded from the formal financial system. Cryptocurrencies have also gained popularity as an alternative investment class. Bitcoin, in particular, has attracted significant attention from investors seeking a store of value or a hedge against inflation. Its limited supply of 21 million coins and the absence of central authority make it an attractive asset for those wary of traditional monetary policies. Furthermore, cryptocurrencies have facilitated the growth of innovative financial products and services. Decentralized finance, DeFi, platforms have emerged, allowing users to lend, borrow, and earn interest without intermediaries. Non-fungible tokens, NFTs, have enabled the creation and ownership of unique digital assets, revolutionizing the art and gaming industries. However, the rise of cryptocurrencies has not been without challenges. The decentralized and pseudonymous nature of cryptocurrencies has led to concerns about their use in illegal activities such as money laundering and tax evasion. Regulatory bodies around the world are grappling with how to address these challenges while striking a balance that fosters innovation while protecting consumers and the financial system. Despite the challenges, the potential future of cryptocurrencies remains promising. As the technology matures, scalability and energy efficiency improvements will likely be made, addressing current limitations. Moreover, governments and central banks are exploring the possibility of issuing their own digital currencies, known as central bank digital currencies, CBDCs, which could further integrate cryptocurrencies into the mainstream financial system. The concept of cryptocurrencies can indeed be traced back to the late 20th century, and the idea of creating digital currencies that operate independently from centralized control has intrigued researchers and computer scientists for decades. One of the earliest attempts at creating digital currency was in the 1980s when an American computer scientist named David Chaum introduced eCash. The concept of eCash involved the use of cryptographic techniques to enable secure and anonymous transactions. Although eCash did not gain widespread adoption, it laid the groundwork for future developments in the field of digital currencies. In the late 1990s, another significant development emerged with the introduction of B-Money by Wei Dai, a computer engineer and cypherpunk. B-Money proposed the idea of a decentralized electronic currency that relied on cryptographic proof of work for verification. Although B-Money was never implemented, it contributed to the theoretical framework of decentralized digital currencies. Shortly after B-Money, in 1998, computer scientist and cryptographer Wei Dai introduced BitGold. BitGold was another precursor to cryptocurrencies and proposed a system where participants would solve computational puzzles to create new units of the currency and validate transactions. While BitGold never gained practical implementation, its ideas served as a stepping stone for future cryptocurrency endeavors. However, it wasn't until the early 2000s that significant progress was made towards the actual implementation of cryptocurrencies. In 2004, Al Finney, a developer and cryptographer, introduced reusable proof of work, RPOW, a system that allowed users to purchase tokens using computational work. While RPOW was not a fully decentralized currency, it demonstrated the potential of cryptographic proof of work as a method for securing digital transactions. Then, in 2008, The pivotal moment in the history of cryptocurrencies occurred with the release of the Bitcoin white paper by an individual or group using the pseudonym Satoshi Nakamoto. Bitcoin represented a groundbreaking concept that combined previous ideas like cryptographic proof of work, decentralized control, and a secure, transparent ledger known as the blockchain. The Bitcoin network officially went live in January 2009, marking the birth of the first practical and widely adopted cryptocurrency. Bitcoin's success inspired the creation of numerous alternative cryptocurrencies, often referred to as altcoins, which sought to address various issues or provide additional features beyond what Bitcoin offered. Some notable examples include Litecoin, introduced in 2011 by Charlie Lee, which aimed to improve transaction speed and efficiency, and Ripple, now known as XRP, which aimed to facilitate fast and low-cost cross-border payments. Since the emergence of Bitcoin, the cryptocurrency space has experienced exponential growth, with thousands of different cryptocurrencies in existence by the time of my knowledge cutoff in September 2021. Alongside this growth, the underlying blockchain technology has found applications beyond digital currencies, including supply chain management, smart contracts, and decentralized applications, dApps. The concept of cryptocurrencies can indeed be traced back to the late 20th century, with various attempts to create digital currencies that operated outside the control of centralized authorities. These early efforts laid the foundation for the eventual development of modern cryptocurrencies like Bitcoin. In the 1980s, the idea of digital cash began to take shape. Pioneering computer scientist David Chaum is often credited with introducing the concept of digital cash through his work on cryptographic protocols. In 1983, Chaum created a cryptographic system known as blind signatures, which allowed for secure and anonymous electronic transactions. This work led to the creation of DigiCash, a company founded by Chaum in the early 1990s. DigiCash aimed to create a digital cash system that would enable secure and private transactions over the internet. While DigiCash made some progress and gained recognition, it ultimately faced challenges and declared bankruptcy in 1998. Around the same time, other ideas for digital currencies were also being explored. In 1998, Wei Dai, a computer engineer and cypherpunk, introduced B-Money, a proposal for a decentralized digital currency. B-Money outlined a system where participants would engage in computational work to create new units of the currency and verify transactions. Though B-Money was never fully implemented, it significantly influenced the development of future cryptocurrency concepts. Another significant precursor to cryptocurrencies was BitGold, introduced by computer scientist and cryptographer Wei Dai in 1998. BitGold proposed a decentralized currency system in which participants would solve cryptographic puzzles to add new blocks to the public ledger and secure the network. While BitGold was never widely implemented, it inspired many of the fundamental ideas behind later cryptocurrency projects. It wasn't until the early 2000s that significant progress in creating cryptocurrencies was made. In 2004, Hal Finney, a developer and cryptographer, introduced reusable proof of work, RPOW. RPOW allowed users to purchase tokens by performing computational work. While RPOW was a centralized system, it showcased the potential of using cryptographic proof of work as a method for securing digital transactions. The true breakthrough came in 2008 when an individual or group using the pseudonym Satoshi Nakamoto published the Bitcoin white paper. Bitcoin, released in 2009, marked the first practical implementation of a decentralized and widely adopted cryptocurrency. It combined elements of previous digital cash and cryptographic currency proposals, introducing the revolutionary concept of the blockchain, a decentralized and immutable ledger that ensured the integrity of all transactions. Bitcoin's success and growing adoption sparked the development of numerous alternative cryptocurrencies, collectively known as altcoins. Each altcoin aimed to address specific issues or offer unique features, leading to a diverse and rapidly expanding cryptocurrency ecosystem. The introduction of Bitcoin and subsequent altcoins paved the way for the widespread recognition and adoption of cryptocurrencies. Over time, Blockchain technology, which underpins cryptocurrencies, has found applications beyond digital cash, including in supply chain management, decentralized finance, DeFi, non-fungible tokens, NFTs, and more. Democratizing finance. One of the most significant advantages of cryptocurrencies is their potential to democratize finance. Traditional financial systems often exclude a considerable portion of the global population due to high transaction fees, stringent regulations, and geographic limitations. However, cryptocurrencies transcend borders, allowing anyone with internet access to participate in a financial ecosystem that is open, borderless, and inclusive. This inclusivity empowers the unbanked and underbanked populations worldwide, providing them with access to financial services, such as remittances, loans, and savings, thereby reducing global economic inequality. Decentralization and trust. At the heart of cryptocurrencies lies the concept of decentralization, eliminating the need for intermediaries like banks and governments in financial transactions. Decentralization, enabled by blockchain technology, fosters trust as the transaction records are transparent and immutable, thereby minimizing the risk of fraud or manipulation. As cryptocurrencies gain widespread adoption, this trust in decentralized networks could challenge and potentially transform traditional centralized institutions. Disrupting traditional banking. Cryptocurrencies have the potential to disrupt traditional banking as we know it. Traditional banks have long held control over financial systems, earning profits through intermediation fees and interest margins. However, cryptocurrencies allow peer-to-peer transactions without the need for intermediaries, reducing transaction costs and streamlining the process. As adoption increases, banks may be forced to adapt their business models or risk becoming obsolete. Driving financial inclusion. Financial inclusion has been a long-standing challenge, especially in developing economies. Cryptocurrencies can play a pivotal role in bringing financial services to the unbanked population, providing them with a digital wallet accessible through a smartphone. This opens up opportunities for the marginalized to engage in economic activities and lift themselves out of poverty. Additionally, cryptocurrencies can facilitate cross-border remittances at significantly lower fees, enhancing financial connectivity for migrants and their families. Smart contracts and decentralized applications. Cryptocurrencies have given birth to smart contracts and decentralized applications, dApps, which are self-executing contracts with predefined conditions. Smart contracts eliminate the need for intermediaries, reduce transaction costs, and ensure transparency and security. dApps are revolutionizing various industries like supply chain management, real estate, healthcare, and governance, offering efficiency and accountability like never before. Safeguarding privacy and security. With the rise of digitization, concerns about data privacy and security have grown exponentially. Cryptocurrencies offer enhanced privacy features, ensuring that user identities and transaction details remain pseudonymous. Additionally, blockchain's cryptographic nature makes it highly secure, significantly reducing the risk of data breaches and hacks. This enhanced privacy and security are crucial for the future, as the world becomes increasingly reliant on digital infrastructure. Store value and hedge against inflation. Bitcoin, often referred to as digital gold, has emerged as a store of value in times of economic uncertainty. Its limited supply, capped at 21 million coins, and decentralized nature make it an attractive option for investors seeking a hedge against inflation and economic turmoil. As central banks print more fiat currency, the deflationary nature of cryptocurrencies like Bitcoin becomes even more relevant in protecting wealth. Tokenization of assets. Cryptocurrencies enable the tokenization of real-world assets, transforming ownership rights into digital tokens on a blockchain. Tokenization allows fractional ownership, making high-value assets like real estate and artworks more accessible to a broader investor base. This process also enhances liquidity, reduces transaction costs, and simplifies the transfer of ownership. Impact on global trade. Cryptocurrencies have the potential to revolutionize international trade by simplifying cross-border payments and reducing currency exchange fees. Cryptocurrencies could serve as a common medium of exchange, eliminating the need for converting currencies in global trade transactions. This streamlining of cross-border payments would promote smoother and faster international commerce. Cryptocurrencies have rapidly evolved from an obscure technological curiosity to a disruptive force with the potential to revolutionize the business landscape. As we look ahead, it becomes evident that cryptocurrencies will play a crucial role in shaping the future of business. These digital assets, built on blockchain technology, offer numerous advantages such as transparency, security, cost-effectiveness, and global accessibility. In this article, we explore how cryptocurrencies are poised to transform various aspects of business, including financial transactions, fundraising, supply chain management, and decentralized autonomous organizations, DAOs. Streamlined financial transactions. One of the most significant ways cryptocurrencies will influence the future of business is by streamlining financial transactions. Traditional banking systems are burdened with complex processes, high transaction fees, and time delays, especially for international transfers. Cryptocurrencies eliminate the need for intermediaries and enable peer-to-peer transactions, significantly reducing costs and processing times. This increased efficiency in financial transactions will benefit businesses of all sizes, from startups to multinational corporations. Borderless commerce. Cryptocurrencies are not bound by geographical borders, offering businesses the ability to engage in borderless commerce. Traditional international transactions involve navigating through different banking systems and adhering to foreign exchange regulations, which can be cumbersome and costly. With cryptocurrencies, businesses can accept payments from customers worldwide without worrying about currency conversions or exchange rate fluctuations, fostering seamless global trade. Enhanced security and fraud prevention. In a digital era, data security and fraud prevention are paramount concerns for businesses. Cryptocurrencies employ advanced cryptographic techniques, making them inherently secure and resistant to fraud and tampering. Blockchain's distributed ledger technology ensures transparency and immutability of transaction records, reducing the risk of data breaches and fraudulent activities. As businesses transition to cryptocurrency-based payment systems, they can gain a competitive advantage by offering increased security to their customers. Access to decentralized finance, DeFi. The rise of decentralized finance, DeFi, platforms is another aspect of how cryptocurrencies will shape the future of business. DeFi offers a range of financial services like lending, borrowing, and staking without the need for traditional financial intermediaries. Businesses can leverage DeFi protocols to access capital, invest idle funds, or obtain loans with lower interest rates and without credit checks. DeFi's permissionless and open nature democratizes finance, enabling businesses to explore innovative financial solutions. Fundraising and tokenization. Cryptocurrencies have revolutionized fundraising through initial coin offerings, ICOs, and security token offerings, STOs. Businesses, especially startups and innovative projects, can issue tokens representing ownership or utility in their venture. Token sales provide an alternative means of raising capital, and these tokens can later be traded on cryptocurrency exchanges, providing liquidity to investors. Tokenization also extends to real-world assets like real estate, commodities, and artworks, allowing businesses to fractionalize ownership and attract a broader investor base. Supply chain management. Blockchain technology, the foundation of cryptocurrencies, has immense potential to transform supply chain management. By integrating blockchain into supply chain processes, businesses can achieve greater transparency and traceability. Each step of the supply chain, from sourcing raw materials to delivering the final product, can be recorded on an immutable blockchain ledger, ensuring authenticity and minimizing the risk of counterfeiting. This enhanced supply chain visibility boosts consumer confidence, builds trust, and reduces operational inefficiencies. decentralized autonomous organizations, DAOs. Cryptocurrencies enable the creation of decentralized autonomous organizations, DAOs, which are entities governed by code and smart contracts rather than traditional hierarchical structures. DAOs allow for transparent decision-making, where stakeholders have voting power proportional to their token holdings. This innovation has the potential to revolutionize business governance, making it more democratic and efficient. DAOs can streamline decision-making processes, incentivize community participation, and foster collaborative efforts among stakeholders. In conclusion, cryptocurrencies have proven to be a catalyst for wealth creation, opening new possibilities for millionaires to emerge from diverse backgrounds. As the crypto space continues to evolve, it is crucial to approach this exciting frontier with careful consideration and informed decision-making. Remember to conduct thorough research, diversify your investments, and practice prudent risk management to navigate the dynamic cryptocurrency market successfully. If you found this article insightful, don't forget to like and subscribe to stay updated with the latest trends and developments in the world of cryptocurrencies. Happy investing!